The first quarter reporting season for 2019 is imminent in the United States, and this particular quarter there are a great many things working against US corporates such that the reporting season will take on extra significance. For example, one of the things that has helped in previous quarters has been the tax credit as announced by President Trump, along with some fairly easy comparatives. Neither of these are likely to be featuring in terms of the upcoming quarter. Indeed, if we look at the performance that's expected in terms of first quarter, earnings are going to be lower by the looks of it by some 3.5% year on year. This compares with the previous quarter, the fourth quarter of 2018, when earnings actually jumped by over 13%. Luckily, in terms of market prices, that lower return is already to a large extent factored in. What's going to be of particular interest, as indeed it was at the end of 2018 against a difficult December, will be management outlook and the sort of guidance comments that we're going to get, because obviously in terms of the second quarter that will continue to dictate the directions of what have been fairly strong markets in most parts of the world in the year to date. So in terms of the overall numbers expected to be lower, what particular sectors will be under the spotlight and indeed are forecast to have been hit particularly hard? Basic materials, of course, they have been under pressure as demand from China is perceived to have waxed and waned. Also, consumer discretionary, a sector where 70% of US GDP is coming from the consumer. Any outsized weakness there could certainly have a detrimental effect. On top of that, of course, the auto sector, a sector dear to the heart of the Americans, is likely to have suffered a significant decline. And also technology, notwithstanding the fact that the index has done well in the year to date, we have, of course, had a couple of warnings from Apple, and we'll need to see how their first quarter is actually panning out. The other thing that's working against companies at the moment is margin deterioration. We've seen some higher labour costs. We've also seen some disruption to the supply chain on the back of the US-China trade war, which of course not only continues to be a factor, but also is now actually coming through in real terms in some of the economic numbers. So that's the corporate side. What have the recent economics told us? Well, we had a very disappointing non-farm payroll figure in February. Some of that could, of course, be down to the cold snap in terms of weather and, of course, the government shutdown. So the non-farm payrolls imminently will be interesting. No Fed meeting scheduled for April, so perhaps that'll put even more spotlight on what companies are actually saying. And in terms of the most recent economic data we've had in terms of sectors, retail sales have been disappointing. On the other hand, manufacturing activity, consumers and construction spending has been quite positive. The final thing that's working against companies, of course, is just to have a look at how the indexes have performed in the year to date. We've seen the Dow Jones up nearly 13%, S&P 500 up over 14%, and the Nasdaq up by 18%, just in the 3 months so far. So there's a lot of things stacked against US corporates. They really need to come up with goods, and it's going to be difficult for them to emerge from this corporate earnings season unscathed.